Hello everyone, this is Raza. So today we'll be discussing the financial function AMORLINC that is mostly used for depreciation. Actually this function is based on straight line methods of depreciation. So how this work? So AMORLINC, as usual, let us start with the name AMORLINC. AMORLINC actually represent the amortizations. Normally amortization used for the intangible assets, but as it is in Excel, so they give this general name AMORLINC. So the function will require initially the cost. The cost actually the amount on which you have the company or organization have acquired the assets. The date of purchase, on the date on which it is purchased, the past period, the period for which they are going to be calculating their depreciation. It is actually the end of the years of the financial year. Salvage value actually represent, or intrinsic value, also sometimes called intrinsic value. It is the value that you will consider after the depreciation that the asset could be sold out on that amount. The period is actually based on for how many time you are going to calculate the depreciation. It could be for 1 month, for 2 months, for 3, or for a year. So, and the other thing that, so let's start these functions. I have this data. These are the some assets that has been purchased the company, and this is their cost. This is the date of the purchasing date, and this is the year closing date. This is the salvage value, and this is the period for which we're going to calculate the depreciations. So as the formula start with AMORLINC, then first is the cost. We will take this as a cost, and we will open the reference as relatives because you're going to down this formula. Then next is the date of purchase. This is the date of purchase. The other is the year, closing year of the company. Some companies have 31st December, some company have 30 June, so I have taken the 30 June. So this is, and the salvage value is 100,000, and the period I have taken this just, and the basis, the rate is I have considered this 20%. So this 20% because we're going to go down this formula, so we'll be freeze this one, and the year is actual 365 days. So let's enter. This is our depreciations for this 1 year of this assets. Now coming down to dragging down the formula down, we will be getting the depreciation for the rest of the assets of this company. It is actually based on straight line method. So if we divide this 20%, this means this is for 5 years. So this divided by 5. See, this is 400,000. We also have a 400,000. The next one, what we did with the period, actually this is the purchase date and this is the year closing date. So it is actually purchased on December 25th. So we have divided this, we have minus this from this and divide by 12 so that we could get the years up in a point. So this is actually the years, and it is this 600,000.